Hello, everyone. My guest today is Frost Prioleau. He's the co-founder and CEO of a company called Simpli.fi. He's an experienced online advertising executive specializing in targeting optimization and technology. Prioleau focuses on corporate strategy, driving Simpli.fi's growth, and ensuring customer satisfaction. Frost, are you ready to take us to the top?
Sure am. Let's go.
All right. Tell us about Simpli.fi. What do you guys do and how do you make money?
So Simpli.fi brings programmatic advertising to local advertisers. So if you know about programmatic advertising, it's taking over just about every form of digital advertising. Most of the investment in it today has been focused on large national brands that buy through some of the big six agencies. We said we're going to go the other way. We're going to be the guys who bring programmatic to local. And so and that means we have to be very good at powering high volumes of smaller localized campaigns. So for the last month, we did 100,000 campaigns, about half of which spent less than $100 a month, and the other half spending all the way up to like $1,000 a minute.
Interesting. And is your business model a pure play SaaS model, or is it a percent of ad spend model?
We're a percent of ad spend model, but we measure ourselves as a SaaS business, and we have, because of some SaaS investors we've had. And so we actually have metrics that are favorable to many SaaS businesses.
What does that mean?
That means like our net recurring revenue. So if we didn't sell a new customer all year, we'd still grow 30% in a year because our existing customers come back.
Is that another way of saying net revenue retention annually is 130%?
That's correct.
That's great. Where's most of the expansion revenue coming from?
Typically from new products that we're rolling out. So programmatic started in display, desktop display advertising, and moved to mobile. We have a very strong mobile solution. And now a lot of the growth continues in mobile, but also in over-the-top and connected TV video advertising.
Interesting. Okay. You mentioned investors. How much have you raised?
We sold about a year ago to GTCR, which is a private equity firm up in Chicago. Prior to that, we'd raised about $10 million.
Okay, good. So not a ton. And were you one of the initial guys? You were the initial founder?
That's correct. Myself and our CTO, Paul Harrison, were both founders and both still active in the business.
Well, so Frost, you know what they say, right, about acquisitions?
I don't know.
Once you make a guy rich, how do you motivate him? Why are you still there?
Well, they were very clever. GTCR wanted both me and Paul to remain on, and so actually, although they really acquired the company, both of us liked the business, wanted to keep working here, and we actually reinvested almost half of our proceeds back in the business. So they made you buy back equity, huh? Well, I wouldn't say made. We were honored to do so, right, Nathan? But no, actually, that was a favorable part of the terms that actually we could buy back equity on the same terms they bought, because hey, otherwise, what would I do? I'd cash it out, I'd pay a lot of taxes, and I'd put it in T-bills somewhere. So I'm happier having it in Simpli.fi stock.
Yep, interesting. Okay, and how many customers are on the platform today?
So we have about 400 customers that are billing customers. We have about 30,000 advertisers, but many of our customers are media companies who have thousands of advertisers working through them.
Yep. And I want to put this on a timeline before I get too deep into this. So when did you launch the company? What year?
2010.
2010. Okay, good. And do you remember how long it took you to hit $1 million in revenue?
That would have been in 2011.
Okay. And how much until you hit 10 million?
Gosh, that would have been, I don't remember those. I would have guessed 3 years or so.
Okay, so maybe like 2013 something?
Somewhere in there would be my guess.
Okay. And then are you comfortable sharing before you sold to GTCR, what was your trailing 12 months revenue?
So we don't share that, but I'll say we're about 250 people now. We're growing at 40+% still, and we've been profitable for the last 3 years.
Okay, 40% in terms of your headcount or your revenue year over year?
Revenue.
40% year-over-year revenue growth. And so,
headcount a little less than that, thankfully.
Yeah, I was about to say, when I hear headcount, I just hear expenses. Tell me about revenue growth, right? 40%, that's pretty good. And you said you're cash flow positive?
Yes, we have been for the last 3 years. One of the reasons GTCR actually looked in this space for many years for a company to buy. And one of the things they liked about us was both our profitability, our growth, and then our network, our SaaS-like metrics.
Yep. I was about to say, private equity firms, they have a tough time looking at top line revenue growth. They want to see EBITDA margins. So if you're cash flow positive, it makes sense why that works.
They absolutely are EBITDA buyers.
Yep. Now, when the acquisition happened, I believe based on my research team said they just bought a stake, not the whole thing. Is that accurate?
Actually, one of the headlines came out saying they had a majority investment, but accurately, they actually did buy the whole thing.
And then you bought back some.
Paul Harrison and myself bought back in.
Yeah.
Correct.
Yeah. That's a nice, a clean way easy way to manage that cap table. Interesting. Okay. So I'm curious. A lot of the ad tech companies that I have on, they are moving from a percentage of transaction model to trying to, sell the ad tech software solution, right? A self-serve SaaS platform. And some are doing really well. Some are not doing really well. Do you have any true kind of SaaS revenue, or is it truly just a percentage of revenue and that revenue spend scales over time? So it looks like SaaS revenue.
So today we are truly percent. We do not have any pure SaaS revenue. We have been completely transparent from day one. So all our customers know when they spend $1 exactly how much goes to our platform fee. If they ask for services, how much goes to that, and how much goes to media and data. So we're totally transparent on that side. But we are working on and actually in beta on some analytics products that could be pure SaaS revenue.
Yep.
But today, most of really that's because the way the buyers want to buy. They don't want to. Agencies don't want to pay us a platform fee plus media. They want to buy one all-in price, and that's the way, as you know, much of the industry is evolved.
That's right. For us, break down the economics for me real quick. Let's pull that dollar example forward. I pay you $1. What do you keep and what gets spent? Typically, on average, I know it probably ranges wildly, but on average.
Yeah, so typically, platform fees depending on the size of the customer, typically go from high single digits to the mid-teens. As far as the platform fee, we offer. While we have lots of customers using our platform on a self-service basis, we also offer a managed service. And so, for those who want to use our managed service, we charge another 10% of spend. Which is actually, if you consider these customers have thousands of campaigns spending $100 a month, it's actually, I think, fairly inexpensive. And then the balance.
And you call that, you call that the management fee?
Managed services fee.
And you're helping with creative there?
Mostly we're helping them traffic campaigns. So they want us to set up, 100 campaigns for different locations of franchises, set up geofences, pull reporting.
Targeting, things like that.
All that, correct. And so those are the two buckets, and then the balance goes to media and data.
That's great.
That's
great.
Two.
So let me break that down. I want to make sure I got it captured correctly. On $1 spend I put through you, on average, call it 9 cents, maybe up to mid-teens, 16 or 17 cents would go towards your platform fee. If I want your help and say, Frost, help me with my 400, car dealerships all spread out. Give me ads for all of them. You might say, okay, there's another 10 cents on the dollar going towards the managed services. So worst case is you got about 26 cents on that dollar going towards the platform and managed services. The rest is going towards the actual ad spend.
Correct. Both data and media. So on that side. Got it.
Interesting. Okay, great. Healthy growth. Launched 2010. Team size is 250 people. Is everyone based in Texas, or are they spread out?
We got about 200 in Texas, and then we got about 50 people spread around the country, mostly sales in all the normal places that you'd guess. But some developers and other service people as well.
And generally speaking, over the past 12 months, how much just pure ad volume was put and processed through your platform?
So that's our spend. We don't disclose that either, but we continue to see that grow, especially as I mentioned on the mobile and the OTT and CTV side. Can
you give me a really big range that allows you to be, vague enough where it's not hurting you competitively?
Well north of in the hundreds of millions. Let me put it that way.
Let me ask you a different question. When do you break $1 billion? Will it be this year, next year? What do you think?
We would grow a lot if it was next year. It'll be a few years down the pike.
Okay, but within striking distance, right? I can see it in your eyes.
It's on our map. On our roadmap. We'll have a big celebration.
That's good. Okay, so a couple $100 million through your platform, and so you mentioned you've got about 400 of those customers. So I mean, it sounds like most of these folks are call it maybe $1 million through your platform, something like that a year.
It varies. So our customers break down into two types of customers. One is media companies who are out selling to local SMBs and local advertisers. And so we power the programmatic offering of cable companies, TV companies, newspapers. And because they have a salesperson out calling, say, on the local auto dealer, and they're selling up a bundle of programmatic, search, social, and their owned and operated inventory. Right, that's about half our business, and the other half of our business is multi-location brands. So these are the two types of large local advertisers. So if you think of quick service restaurants, real estate companies, insurance agencies where they have hundreds or thousands of offices, we go in and customize campaigns around each one of those offices.
Yep. Well, I'll just be transparent with you. What I'm actually trying to do is to back into your what your revenue is after media spend, right? So if I'll do a back of the napkin here, right? If you're doing a couple $100 million right now in ad spend, call it $300 million, and we just talked about call it a 10-cent platform fee, right? So there's $30 million right there, and then if I think you said managed services, I don't know what percent of them use managed services, but there's potentially another $30 million there. So I mean, is it fair to say, I won't get too specific here, but is it fair to say you guys are doing north of 25 million at this point per year?
Well north of that, yeah.
Well north. Okay, very well. Look, I would give you more credit, but I don't want to be too specific. You can give me a better number if you want.
You're doing great math. You're a mathematician. You're doing great.
Fair enough. We'll leave it at that. Where's your future growth going to come from? Drive more ad spend, keep that 130% net revenue retention annually going, or is it adding new product lines?
So a lot of that net revenue retention comes from product lines, right? So we grow along two ways. One by we're a platform. We started with desktop. We had a very strong mobile solution. The next big leg of growth is coming from, again, CTV and OTT spend as TV advertising comes over. So that's how we're selling more to our existing customers by extending our product line. And then we're continuing to add more media companies who have local in TV, cable, newspapers who have local sales forces. We power their programmatic offering. Then on the flip side, we're growing very, very quickly with multi-location brands. So brands with hundreds or thousands of locations who are looking to localize campaigns, both the targeting and the messaging around each of their stores.
There's a lot of pressure right now, just because of how much ad spend is done annually across the globe, trillions of dollars, to remove folks like you, the middlemen. People see opportunity there. And so a lot of people have said, well, hey, maybe blockchain can solve this. People like you would say, well, no, we add a real value. We make the dollar go further with our platform fees. How do you avoid just getting undercut by someone else saying, okay, we're going to charge 5 cents instead of 10 cents for our platform?
Yeah, so we've got to add value. So that's the one thing about being completely transparent is our customers every day can say, hey, is Simpli.fi earning their fee that they're charging me every day? And can someone else do this better? And so as you see from our net recurring revenue, our net revenue retention, they're voting with their business that we are doing well because they're adding more and more spend through our platform. But yeah, we've got to be competitive. We've got to add value. We've got to be the most efficient way for them to buy media. And especially when you look at the types of campaigns that we're running, which are high volumes of small campaigns, there's a lot of automation that has to go into, when you're thinking about running 100,000 campaigns like we did last month, 50,000 of those were spending less than $4 a day. So there's a lot of automation that has to go into getting those campaigns up live, optimizing, reporting on them, and delivering the kind of performance that they expect.
Last question here, Frost, before we wrap up with the famous five. And I saved the best for last, so prepare yourself. Hold on to your armchair here. A lot of companies, when they sell to a private equity firm, especially if the founders stay and are still involved, and especially if they are still on the cap table, it's not uncommon to see them actually do a take private. Not take private, but actually buy back their companies from the private equity firm. Any plans from you and your co-founder to do that with GTCR?
No, none at all. GTCR, they're great partners, and we're sitting there alongside them. We're happy, and we just want to grow the investment and keep growing the company. All
right, GTCR, if you're listening, you got to give this guy a raise. I mean, he's saying all the right things. Come on, double the salary. And Frost, I want 10% if they double it. Okay.
I'll let you know.
That's my platform fee. All right, Frost, let's wrap up with the famous five. Number one, what's your favorite business book?
Right now, it's Bad Blood.
That's a good one. Number two, is there a CEO you're following or studying right now?
Well, I was following Elon Musk, but I may need a new mentor here. Tweeting patterns recently.
That's right. Number three, what's your favorite online tool for building your business?
Slack. No. Totally been fantastic for our business.
Number four, how many hours of sleep are you getting every night?
Between 7 and 8. I try for 8 and I get around 7.
That's good. And what's your situation? Married, single, kiddos?
Married for 30 something years. I got 3 kids.
Wow. Congratulations. And how old are you?
I'm the ripe old age of 57.
57. Last question, Frost. What do you wish your 20-year-old self knew?
I wish I knew from a business side the importance of business models, and so just how important the business. If you're going to start a business, really look at the business model and how important it is to both have recurring revenue, and then secondly, just to build a company with a great culture, which has been a really fun thing about Simpli.fi.
Guys, focus on the business model. Simpli.fi was taken private by GTCR back in August, September of 2017. Again, playing aggressively in the ad tech space. They're processing hundreds of millions of dollars of ad spend through their platform over the past 12 months, and the economics look good. It must be working. Net revenue retention annually over 130%. Their team of 250 folks deserves a lot of credit, based in Texas and other remote locations. Founded in 2010, passed $1 million in 2011, $10 million around the 2013 timeframe. Today, call it doing well north of 25, $30 million in revenue each year through their platform fees, management fees across about 400 paying customers. Frost, thank you so much for taking us to the top.
You bet. Thanks, David.